Buying 100 shares of a growing company is straightforward. You pay the market price and you own the equity. This approach requires a massive pile of cash up front and locks your risk-to-reward ratio at exactly 1-to-1. The alternative is the options chain. To the uninitiated, this appears as an intimidating wall of numbers, dates, and financial jargon moving at light speed. This grid is a strategic toolkit. It allows investors to control a large number of shares for a fraction of the capital, or purchase direct insurance to protect stocks they already own. Navigating this system requires mastering 3 specific variables: calls, puts, and strike prices. At its most basic level, an option is a contractual agreement between 2 parties, a buyer and a seller. The contract grants the buyer the right to buy or sell a specific stock at a predetermined price. Crucially, the buyer has no obligation to follow through. They hold the choice to act or let the contract lapse. Standard options contracts represent control over exactly 100 shares of the underlying asset. Options trading focuses on purchasing a strategic, mathematical choice about a stock's future price movement. Investors use call options when they predict a stock's price will rise. Imagine a hypothetical stock, XYZ, trading at $100 per share. You buy a call option with a strike price of $105. This locks in your legal right to buy the stock at that specific price, regardless of how high the market goes. This right requires an upfront cost, known as the premium. In this scenario, you pay the seller a premium of $2 per share to secure the contract. If the stock suddenly reaches $120, you can exercise your right to buy at your $105 strike price, securing shares far below current market value. You pocket the difference between your strike and the market price, minus that initial $2 premium. Because you controlled 100 shares with a small initial investment, your percentage return significantly outpaces buying the stock outright. Profitability requires the stock price to climb far enough to exceed the initial cost of the premium. Your break-even point is the strike price plus the premium. 105 plus 2 means the stock must hit $107 to generate a profit. When it crosses that threshold, the option is in the money, possessing intrinsic value. If the stock fails to reach your strike price by the deadline, the option is out of the money and expires entirely worthless. One major advantage is that your downside is strictly capped. If the trade fails, your maximum loss is the premium you paid up front. A put option is the inverse tool. It provides the right to sell a stock, used to profit from a price drop or to hedge against a market crash. Suppose you own 100 shares of XYZ stock at $100, but you suspect the market is about to crash. You purchase a put option with a $95 strike price for a $3 premium. This creates a guaranteed floor for your shares. If the market plunges and the stock hits $70, your put option retains its value. You can legally force the seller of the contract to buy your shares at that locked-in price of $95. This upfront premium acts as financial insurance, shielding your portfolio from a devastating loss. Options are temporary contracts with a strict deadline. Unlike common stocks, they cannot be held indefinitely. This introduces time decay, or theta. The extrinsic value of an options premium constantly bleeds away as the expiration date approaches. If the underlying stock remains stagnant and stays at the money, time decay alone will erode the premium until the option expires worthless. Options trading is a race against time. The investor must accurately predict both the direction of the market and the timeline of the move. When we return to the options chain, the data grid becomes legible. You can now identify the C for calls, the specific strike prices, the expiration dates, and the bid-ask spread that determines the premium. These contracts are a double-edged sword. They offer leverage to amplify gains and act as portfolio insurance, but they demand precise timing and a firm grasp of your break-even thresholds. Mastering calls, puts, and strike prices allows an investor to evolve into an active manager of risk and reward.